Now we'll hear from Seth Meyer, Associate Director of Food and Agriculture Policy Institute and Research Professor at the University of Missouri. Meyer joined, here we go, one of these acronyms here, CAFRI, from the U.S. Department of Agriculture World Agricultural Outlook Board in Washington, D.C., where he had served as chairman since 2014. WOA is the focal point for market intelligence in the USDA and clears all Outlook publications for the USDA to ensure consistency of estimates across the agency. Previously, he worked as a senior economist with the USDA's Office of the Chief Economist and as an economist with the Food and Agriculture Organization of the United Nations in Rome. Before working in Rome and in Washington, D.C., Meyer was previously part of FAPRI from 2004 to 2011, working his way up to associate professor and policy analyst. He now rejoins FAPRI as associate director. He is an expert on U.S. and international agriculture commodity markets, as well as agriculture and biofuel policy. Meyer has been a visiting scholar, researcher in both Japan and Italy, and an invited speaker at conferences across the globe. He received his PhD in agricultural economics from Missouri. Seth, with that kind of bio, you could get a chair at our Table of Truth country store every morning.
I think I'm going to have to shorten up that online bio. All right. So that was a long way of saying, I was in Missouri about a decade ago, and what's hidden in that message is I was most recently working at USDA. You know that monthly report that gives all the producers anxiety? I led that group. That was me. That was putting together one of those two reports. So I'll talk to you a little bit about what I see. I do want to say I was talking to Secretary Perdue a few weeks ago, asked me how Missouri was treating me, said I was happy to be back in Missouri, happy to be back at Kaffner at the University of Missouri, and that I was happy to be within walking distance of a dock I could fish off of. All right? So, but beyond that, I'm really happy to be out here to be able to talk to you all and tell you a little bit about what we see in the marketplace. Now, having said that, I think your president also pointed out a few things. I'm probably not going to be the most optimistic speaker of the day, but I also want to tell you what we're looking at. What I'm going to show you is my thinking without a trade agreement, and so maybe there's an upside. We'll talk more about this. And they asked me to talk about trade, but I don't think you can talk about trade this year without talking about a whole bunch of other things. And I was a little bit fearful of saying, the president said, well, the year's over. I was a little bit fearful of saying the year's over because things keep happening. I think for many producers, they'd be pretty happy to close the book on 2019, turn the page, and look for 2020. But having said that, I don't think we can't avoid talking about some of what we saw in 2019 as we pivot and we talk about trade, we talk about African swine fever, we talk about some of these things that are going to continue to have an effect in 2020. I don't think we can get by without talking about last year, but let's knock on wood, year's not over yet, let's hope we finish okay, all right? We'll talk about everything. We'll talk about biofuel policy as well, too. And maybe what we see, maybe not the next couple of years, we'll talk a little bit about that, but what does next year look like as well, too? Again, can't get away from talking about what we saw this year. This is simply what we planted in 18, what farmers said they wanted to plant in 19, and what they were actually able to plant when it comes to planting this year. Big downward adjustments. Record large prevent plant in corn and soybeans. You heard folks talk about that affecting inputs. Again, really a cut in production based upon those two factors. Maybe a little bit more corn than folks had anticipated early in the year. Talk a little bit about that. But remember what the price signals were when you all were going into the field to plant corn and beans this spring. The other side of this is not only did we have reduced acreage, some of that crop was planted into less than ideal conditions with less than ideal growing conditions, and folks still trying to get that crop out of the field in some locations. And that's why, I don't want to call 19 finished. We even have trouble getting the crop out, let alone some propane problems drying that crop down. So let's just cross the fingers for the rest of the year. But what you're looking at was also a reduction in yields, okay? So we set ourselves up with what are prices which have come down from what they were several years ago, but also cut in overall production. So, again, I want to finish up talking about this year, but I think one of the big surprises this year, Will, was how farmers responded to that soybean to corn price ratio. You remember at planting time, corn prices really strengthened relative to what they were before, say in April. Those corn prices really strengthened, and although some folks couldn't get in to the field, others could, and that's how we ended up with that corn acreage that surprised a lot of folks. Okay, so this is another one of those things, uncertainty about whether producers could get in the field or not, causing a lot of volatility in corn prices and a lot of anxiety in terms of what the prices for those crops were going to be. So when we look out here at corn supply, and again, this is all recorded, so I'm just putting these things up here to point out a few specific things for you. I don't expect you to look at every single line, every single square on this page, but what I do want to talk to you about is, we cut supply pretty substantially here, but one of the other challenges that we've been having this year is in the export side for corn as well, too. Brazilians have been having a good crop, been exporting hard into our own harvest, and that's produced some challenges for us. And when we flip forward, one of the themes that I think to remember is if we have a more normal planting progress next year, and if we have more normal yields, that's going to be quite a bump in supply. It's going to be quite a bump in supply for most crops, and that's going to put some downward pressure on those prices. Again, I'm assuming no trade deal when I talk about this. That seemed like an extreme assumption last year when I was doing this, that we wouldn't have a trade deal in the next 12 months. But I don't know now. We do have some discussion about a phase one trade deal, but that's my base assumption. So when you think about this, you can make your own mental adjustment, and we'll talk about this in the face of a trade deal. Okay? So when you look out, what does that mean? What does that mean with additional supplies? Is that maybe you actually have some softening of those corn prices for the next several years, absent some crop shock, absent some trade deal. We can maybe see prices continue to be moved lower and stay in that 350 range. Again, probably not the most positive message from where we've been seeing prices, say 2010 to 2015. On the other side of this, the big shock was those corn acres got planted and didn't get shifted into soybeans. We have an incredibly big decline in overall soybean area relative to expectations, and soybean area coming in, again, surprising people how little of that soybean area actually got in. I think if you have to look for something positive here on the soybean side is we've gotten ourselves down to a stocks to use, a stock level for beans, a carry-out stock level for beans, which we thought might take us several years. Look at where we were at. We almost had nearly 1 billion bushels of carry-out when the Chinese trade friction began and that bean crop was already in the ground last year. We had huge carry-out stocks. If you need to look for a silver lining in prevent plant this year, it's that we've actually drawn down those stocks to something a bit less extreme. It's still a big stock level, and it still hangs over the market and makes it difficult to get a big price rally, but we're still making a substantial cut in what carry-out stocks were. So here you can see it. We came down, that stock jump, again, China comes in, slaps tariffs on, that bean crop's already in the ground, those carry-out stocks jump. We were able to draw down those stocks in part because we had a lot of prevent plant acres. But those stocks are going to continue to overhang the market, and if we get more normal planting weather, we're likely to have a little bit of a stock build as well too, which again is going to be a challenge when you go to marketing your crop. Prices may be a bit lower. So when you look at this, you're talking about prices maybe dropping around this 850 to 875 in the coming year, absent a trade deal. Absent a trade deal. Okay, so let's talk about, now we kind of set the stage saying without a trade deal, what does things look like next year? Maybe some challenges in terms of pricing, maybe hopefully fewer challenges with respect to getting the crop in and out of the field. So we know this story, and again, I guess if I was standing here next year making an outlook that said we won't, I'm going to assume no trade deal in this price projection, I'd have been a little bit more uncomfortable with it, but it's certainly gone on longer than I might have expected. And almost every U.S. agricultural product into China now faces an additional 25% tariff. That's not a 25% tariff in total. Some of you may have seen that the Chinese opened their market for poultry again to us. That wasn't a change in the tariff. It was merely a response to avian influenza. They now allow our product in, but it still faces an additional 25% tariff. Okay? So we now have a discussion. There's been a lot of discussion about a phase one agreement that the Chinese will buy $40 to $50 billion of agricultural products from us each year. What does $40 or $50 billion of agricultural products look like relative to what they have been buying? Here's what they've been buying in the past. Here's what actually they've been buying in the past, and you can see what they were purchasing on the order of $25 billion worth of agricultural products prior to trade friction, and how substantially it's fallen in the last year and a half. So again, purchases of $40 to $50 billion of agricultural products would be a significant increase to this. What's the makeup of those agricultural products going to be? Okay, hard to envision that much additional soybean trade relative to what they were purchasing. But what about pork? What about some other products which may have been transformed? So beef, pork, poultry. Some of these products is the easier way to get you to those type of levels. But again, relies on some change in current tariff rates. So the other side of this is, you talk about a change. If there's a trade deal today, does that instantly mean we go back to the very, very large volumes of Chinese trade in soybeans? Perhaps not. African swine fever has had a significant impact on their overall demand for beans, for soybean meal, and it isn't clear that there's a quick way out of this. So when you look at this, you can see out there that exports of soybeans to China fell almost so your exports to China almost 22.8 million metric tons. You only gained half of that back by selling to other folks. The other half of it was a loss. Trade in beans has fallen by 11.4 million metric tons. This represents the first, so this is the other part of this though, Chinese soybean imports. Chinese soybean imports have been incredibly strong for over a decade. This is one of the things that USDA has underestimated. The strength of this demand over the last decade has been stronger than expected, which makes this sudden slowdown and actual decline in their demand so shocking. So far, they have taken in 20 million metric tons less than we originally expected them to take in. Huge percentage reduction related very much to African swine fever. So, again, I'm mixing things up here. So it isn't immediately clear that a trade deal would bring those bean sales back, but maybe it'll bring pork sales back. We'll talk about that in a second. But as we look at the impact on trade uncertainty, we're a policy analysis group, so what we do is we look at what we think the impacts have been from trade friction with China and what those market impacts would be. So these are some of the estimates this is what we estimate those trade impacts on a per bushel basis has been across all of these commodities. The first thing that'll jump out to the producers is this looks much different than the MFP payments from the first round, right? You got MFP payments, which were very tiny for corn and really big for beans. But then the difference there is those were meant to be, the name is purposeful, market facilitation payments. It's not a price support payment, it's a market facilitation payment. So the Secretary's exercising the authority that's available to him in making those payments. All right, so that's how those payment rates come about. But you can see the crop's impact from the market varies based upon that crop's how directly influenced it is by trade with China. Don't trade much corn with them, therefore the impacts are going to be mostly indirect through other crop areas. So when you look forward to MFP payments, again, you can see regionally who's getting the payments based upon those crop impacts. So these are much more based upon they look much more like market level impacts, so areas that have significant amount of cotton where there's a big impact are going to see big payments. As well as you can see the center part where corn and beans are a big deal, they'll see payments as there as well too. But what happens to MFP payments as we move forward? Okay? We'll talk about that. It's been a big bump to the bottom line. It's taken farm income from being below average and probably a negative year to actually putting some folks in the black. Okay, so do MFP payments continue in 2020? There's at least been a lot of discussion about that. African swine fever is the other side of demand. Big reductions in Chinese hog numbers. The Chinese themselves say they've lost 40% of their sows. 40% of their sow numbers have been lost in China, and that's what they say. Who knows what the true answer is? Okay, having worked with Chinese data in the past, I'm somewhat skeptical of the fact that whatever they report is either well known or highly accurate and not influenced by what they want you to know. But the point is they themselves have said they lost 40% of their sows. So I want you to look at this. This is Chinese supply of pork and use. And remember, total U.S. pork production is about 12.5 million metric tons. Total U.S. production. The decline in Chinese consumption has been greater than the entirety of our annual pork production. Okay? And you can see that they've made adjustments in their consumption. We expect them to continue to make adjustments in their consumption. And even that small increase in pork trade that you hear causing all these ripples is a tiny drop in the bucket relative to their overall consumption. So here this is in a scale. So red is 19, blue is 2020, projected what we might expect to see. Bigger declines in Chinese consumption with very modest offsets in terms of trade at the moment, but those are already what some of pork trade is relying on, and those are very small amounts. Again, their overall decline in consumption for 2020 more than our total production in a year. Their decline in consumption likely to be more than our total production. So one of the benefits, one of the risk areas in terms of livestock is we have seen pretty consistently over the last several years strong growth in meat production. Now that's been supported by actually surprisingly good domestic demand. And on the other side of that is we've seen big increases in pork production. Thank goodness we've had increases in slaughter capacity in order to serve that with those record weekly kills. Otherwise, we'd have a lot of hogs looking for a place to be slaughtered. But therein lies some of the risk as well, too. The domestic use has been supporting those hog numbers as well, too, but they continue to expand. So when you look at overall outlook for pork, everything's moving full steam ahead. We're seeing strong expansion in all meat categories, strong expansion in pork exports. We've got a lot of demand uncertainty. We've seen parts of the hog struggling. We see pork exports, particularly to China, increasing relative to where they've been. And so you have a lot of uncertainty when it comes to pork profitability next year. Do we get a trade deal with China? The easy way to get to those dollar values would be to send them pork. We don't get a deal. We have any economic slowdown. Does that trim people's demand for pork domestically? Okay, so there are some profitability could have very different outcomes for pork. But it is one of the ways that you could see getting to the phase one trade deal that's been talked about. So far, the Chinese have been, I talked about this not being a big volume, and relative to Chinese consumption, it's not a big volume, and we haven't benefited very much from it directly. That is because we have a tariff on our pork to China, but The EU is eventually going to run short of exportable supplies as their market tightens up, and that might provide us an opportunity in 2020 as well too. But mostly we have been benefiting after the fact as the Europeans send pork to China. We're seeing those pork shipments finally pick up. Heard a lot about sales. Again, these are fairly small numbers in the grand scheme of things, but already providing the necessary support to the pork market. But trade, we talk about trade uncertainty, so I can't tell you if we're going to have a trade deal. I don't know if we're going to have a trade deal, but there are other things sitting out there which are causing a bit of uncertainty as well too. We got USMCA, and USMCA, not such a big change from NAFTA, but that's not what we're looking at right now. The bigger risk is no USMCA, not NAFTA to USMCA, it's no USMCA. We got about 8 days left this year for which they could take action on that. That's one of the risks. So it's not, again, it's not that USMCA is such a big change from NAFTA, except maybe there's some good advantages for dairy. It's more of, does something happen that causes us to lose USMCA? Okay. Other trade issues, there have been other things going on. So USMCA requires some congressional action, but other things do not. So US trade agreement, US-Japan trade agreement, great for things like beef. Executive action, doesn't take anything. Not so different from from TTP, the prior version that we pulled out of. But again, the risk here would have been not having that trade deal and having your competing countries that did go with TPP have an advantage against you into those markets. Again, probably good for beef, pork, cheese, nuts, berries. Chinese renewed access for poultry, so if we ever get a trade deal, the poultry folks can take advantage of that as well too. Again, that was based upon avian influenza, still a tariff on those products. So let's talk about some of the other things on uncertainty. You've probably heard in the news a lot about biofuels, small refinery exemptions. Okay? This is formerly a big driver of increased grain consumption on an annual basis, but what you've seen is that that has slowed down considerably as we kind of push up against the blend wall. Loosened that up a little bit with E15, year-round E15, loosens that blend wall up a little bit, makes a little bit more room for ethanol in the marketplace. But what you've also seen is the EPA come in and issue a lot of small refinery exemptions after the fact. What does that mean? There's a mandate. EPA comes in and issues small refinery waivers. So they say the mandate is 15 billion. They come in and issue the small refinery waivers after the fact, and it's really more like 14 billion. So they advertise 15. All the research that supports that number says 15. After the fact, they come in, issue those small refinery waivers, and it's really 14 billion gallons. The question becomes now, as you've seen in the news, that EPA is changing the way they're doing this. We'll see. I think there's an incredible amount of uncertainty how that actually turns out. We won't have 15 billion gallons this year for 2019. We'll see if we get it for 2020. But I think it is safe to say, at least under the current environment, that's not a big driver for demand going forward. These small refinery waivers are sitting out there pushing down on biofuel demand, or at least keeping it from sparking that investment that folks need to produce and consume additional ethanol. So you'll see some folks say, hey, it's had no effect on demand. It's also cut the willingness of a lot of folks to say, I'm going to invest in biofuel distribution because I don't know what the policy is going to be next month, let alone next year. So that's one of the ways that this has affected it going forward, is it's created a lot of uncertainty, and who wants to invest in the face of considerable uncertainty? There have been some positives, E15 being one of those positives, but also, so you all know, beyond 2022, EPA gets to decide what the volume is every year, whether it's 15 or not. There's some legislation that sits out there that dictates it until 2022. After that point, it's whatever EPA wants it to be. Okay? So these are not the kind of conditions, these are the kind of uncertain conditions for me that really push down investment to expand biofuels So I think it's probably a reasonable assumption that it's an uphill struggle to get additional biofuel demand from in the coming years. One of the other challenges, one of the other things that you'll hear in the news is there's been talk about Brazil and Argentina and exchange rates, okay? Their exchange rates have been weakening considerably. These folks are our competitors. Now, to be fair, these exchange rates are a result also of very poor economic conditions for them. I think the farmers in Argentina would trade a different government for a stronger currency at this moment, because what they're worried about is incredibly increases in taxation on their exports. So their currency's weakening, makes them more competitive against us in the global market, and that's part of what you've seen in terms of our ability to export corn is their currencies are pretty weak. But it goes with poor economic conditions in those countries as well, okay? So this is yet another challenge I think we face, at least in the short run. And at least at the moment, there isn't a big sign of inflation and big sign of need for increased interest rates, okay? At least so far, inflation has been pretty tepid, so that's one of the opportunities as well. So, last couple slides. When we look forward to next year, I think the issue is we turn to normal planting progress, we return to normal yield, we return to more normal production, we're going to have big supplies. We're going to have to figure out something to do with it. Maybe from an elevator standpoint, bigger supplies, you get an opportunity to provide inputs for that additional production. Those are positives, right? But from a price standpoint, got to figure out something to do with it. Going to have to figure out how to store it, export it, and under current situations, it's hard to envision not building stocks without a trade deal. Building some stocks in those grains and pushing down prices. And finally, after having said things that maybe not the most positive in terms of price aspect, we're also nowhere close to we were in the 80s, okay? Now, we've seen some uptick in debt to asset ratios, expect that to continue, but again, we are nowhere near where we were in the 80s, and I think we kind of get in this framework of comparing ourselves to 2010 to 2014, which were unprecedented. We had farm income for a string of 5 years, above average farm income for the longest period since post-World War II. That's how good those years were in an aggregate sense. So what you're experiencing now, absolutely, these are tough times. They are absolutely tough times. But again, I think you got to keep in mind that 2010 to 15 were exceptional as well too. So there are opportunities. I've talked to you about what I expect, what I see in the future without a trade deal. Get a trade deal, maybe you sell a lot of pork. Maybe you get back in the soybean market. Depends on how China resolves its own issues with African swine fever. Maybe they decide they want the meat and don't want to rebuild their own herd. Or maybe they continue to have challenges with rebuilding their own herd. There are opportunities there to sell them additional ag products. But I think in the absence of that, we do have some challenges in terms of a rebound in production. All right? That's all I got for you, so thank you very much for your attention.